Okay, folks. Okay, so today we're going to actually start on the mechanics of discount rates. And as I said last session, when you talk about discount rates, you need a risk-free rate. Without it, you're kind of lost. So I'm going to start the class off with a few questions about risk-free rates. So let's say you're valuing a Brazilian company. Okay? In nominal reais, so you have a choice. You can either value in nominal reais or US dollars. The risk-free rate in Brazilian reais is 7.5%. Let's say that we know that. And it's a little more difficult than getting a risk-free rate in US dollars. Let's say the risk-free rate in US dollars is 2.5%. Same company, same point in time, same information. You can value it in dollars or you can value it in reais. But the risk-free rate in reais is 5% higher than the risk-free rate in dollars. Which currency are you going to get a higher value in? So I want to think through the mechanics of DCF, right? So I'm going to do a dollar valuation or real valuation. So is it going to be in US dollars since the risk-free rate is lower? After all, if you have a lower risk-free rate, the discount rate is going to be lower. Is it going to be in nominal reais because you'll gain from exchange rate depreciation over time because your cash flows will get converted into US dollars? And maybe it doesn't matter. You should get the same value. Okay? US dollars, nominal reais, or it shouldn't matter. Before you answer though, again think about it. Remember last session I asked you when you did equity valuation, would you like to see the same answers? So let me ask you the same question here. Would you like to see the same answer or different answers? I'd like to see the same answer. Otherwise I'm going to have trouble, right? Because I'll have 4 currencies and 4 different valuations. And in this case, your wishes will come true if you do it right. In fact, one of the things we're going to talk about is being currency consistent. It's really difficult to do, but if you're currency consistent, the value that you get for the company should be currency invariant. If I value Embraer in nominal reais, I should get exactly the same value for the company as if I value Embraer in US dollars. Okay? Sounds like it shouldn't happen because the discount rate should be so different, but you're going to see something else compensate. Okay? In much of Latin America, until probably 10 years ago, people used to do things in real terms, not real terms, but so it's very little confusing. Real terms. What does that mean? They got so burnt by inflation that they said, we don't want to bring inflation into the game. When I project revenues for a company, I'm going to project out the number of units sold, keep prices in constant dollars, in today's dollars, and get my expected revenues, cash flows in real terms. And if you do things in real terms, then your discount rate has to be a real discount rate. So again, think about the same choice, and I'm not even going to ask you because the same conclusion you hope will hold. Will your value be different if you do things in nominal or real terms? The answer is not really. Even though the discount rate might be low when I do things in real terms, you're going to see something else compensate. For the moment, I'm going to leave it at that because one of the things I want to talk about today is why do currencies even matter? Currencies are measurement mechanisms. What I mean by that is you take an awful company, you can't make it a great company by switching currencies. And if you do, something's wrong with your valuation. Currencies should not make good companies into bad companies or bad companies into good, but in practice they often do because people mangle currencies. Let me take another urban myth that you probably have read about, watched on CNBC. If you ask a lot of portfolio managers, you know over the last decade, active portfolio management has had a very tough decade. Now, once you get past a year, 2 years, 3 years, you get to a decade, maybe this is not really just another tough period, maybe this is it. But we ask portfolio managers, why have you underperformed the market? What's going on? You know what their answer always is? The Fed did it. The Fed is this very convenient entity you can blame. The Fed did it. And why? Because the Fed has kept interest rates low, at least according to the story, for the last decade. So is that true? The Fed is. Go along. You don't have to. Don't have to give me the answer I want to hear. Isn't that the conventional wisdom that the Fed has kept rates low, both in the U.S. and in the EU? Let's say the FOMC is meeting today, Federal Open Market Committee is meeting today. It's not, right? Let's say it's meeting today to set rates. If they set rates, will the rates change? No, the question I'm asking is, what rates does the Fed actually set? Because, we have Treasury rates, T-bond rates, T-bill rates. Which of these rates does the Fed actually set? I wanted to think about that because I think for the last decade we've been lazy and consigning blame to the Fed, saying the Fed did it, and not thought about what it is that keeps rates low or high. Okay. So I'll let those things all swim in your mind because today's session is going to be primarily about risk-free rates and currencies, because it is perhaps the most mangled aspect of valuation, is how people deal with currencies and deal with interest rates. Okay. I've lost my batteries again. Don't ask me how this happens every session, but I'll have to keep running back to the... Yeah. So let's go back to our lecture notes. We were talking about discount rates. So let's talk about the risk-free rate. I'm going to give you my definition of what makes a rate a risk-free rate, and then we'll start looking for what we could then use as a risk-free rate. When you have a risk-free investment, you know exactly what you're going to make on that investment, guaranteed, at the time you make the investment. Guaranteed. For something to be risk-free, then it has to meet two conditions. The first is the entity issuing the security has to be default-free. This is a 0-1 game. You can say, what if there's a little bit of default risk? That's like being a little bit pregnant. It doesn't work. It's one of those things. You're either default-free or you're not. And already you're going to see this start to become a problem when you look for risk-free rates. Okay? So it has to be default-free. Second, for something to be risk-free, there can be no reinvestment risk. So what are you talking about? Let's say you have a 5-year cash flow and you want a 5-year risk-free rate. Assume for the moment the U.S. Treasury is default-free. You see why this has to be an assumption? There's no guarantee that the U.S. Treasury cannot default. Assume for the moment the U.S. Treasury is default-free. And assume you have a 3-month T-bill rate. T-bill rate basically is U.S. Treasury rate. Is a 3-month T-bill rate risk-free if you're looking at a 5-year cash flow? Why not? Because at the end of 3 months, you got to reinvest at a rate you don't know today. At the end of 6 months, you got to do it again. So clearly a 3-month rate is not risk-free if you're looking at a 5-year cash flow. So what should I use instead?
5-year rate.
I could use a 5-year rate, but there is a little catch even with a 5-year rate. Every 6 months, what do I get on my 5-year Treasury? I get a coupon, which I reinvest at rates I don't know. So that coupon is a pain in the neck. If I can somehow remove the coupon from the Treasury, I'll have a purer risk-free rate, right? Can you do that? It's called stripping a Treasury. So think of a Treasury as this big coupon book, right? They have coupons every 6 months and you have the face value at the end. You can take the coupons out of the Treasury and make it a 0 coupon bond. A 5-year 0 coupon bond, if the U.S. Treasury is default-free, is the purest measure of a risk-free rate if I want it for a 5-year cash flow. I've opened a Pandora's box here now, right? Because when you do valuation, you've got cash flows in year 1, cash flows in year 2, cash flows in year 3, cash flows in year 4, cash flows all the way through year 10. And if you're a purist, what should you do then? Find a 1-year 0 for the 1-year cash flow. Forget about using the PV function in Excel. It's gone now, right? Because every cash flow will now have a different discount rate. What a pain in the neck. We have enough troubles on our plate without making the risk-free rate one more trouble. So I'm going to suggest an approximation that works for me. If it doesn't work for you, stay with the purist approach. Have a different risk-free rate. Okay? If you tell me when your cash flows come in, and I can on average come up with a duration for those cash flows, I'm going to try to find one risk-free rate with roughly the same duration and use that as my risk-free rate for every cash flow. So in a typical valuation, think about it, right? You got cash flows in year 1, 2, 3, 4, 5, 6, 7. And even though you stop in year 10, that's actually you're not really stopping, right? Because how did you get the cash flow in year 10, that big terminal value? By assuming that your cash flows would go on and on forever. If you think about the duration of your cash flows, especially if you're doing valuation, it's really long. Whether it's 15 years, 17 years, 12 years, 11 years, will depend on whether it's a growth stock or a mature stock. So you're saying, why should it matter? A mature company, you get more cash flows up front. So if you think of it like a bond, a mature company, the duration might be 7 years, so a growth company, it might be 25 years. If I can find a Treasury with roughly the same duration, I'm going to use it as my... You're saying that is an approximation. You're right. But being a purist is going to add so little to my present value that I'm going to save that effort for something that actually matters. So here are some general propositions about risk-free rates before I throw you some questions. First is, if you ask me what the risk-free rate is, I cannot answer the question unless you tell me over what time horizon. The risk-free rate over 3 years or 5 years or 10 years is going to be very different. Second, if you ask me what the risk-free rate is, I'm going to stop. Tell me in what currency. There is no one global risk-free rate. There's no universal risk-free rate. It's currency specific. And third, when I was taught corporate finance with my MBA program, in fact, the entire 2 years, I think you spent a minute and a half on the risk-free rate. I was told to use the US Treasury rate as my risk-free rate, and we moved on. Shows you how dollar-centric my MBA class was. But it also gives you the sense that if you have a government bond, it must be default-free. That's actually kind of implicit whenever they say, use a government bond rate as a risk-free rate. So I'm going to state my third proposition. Not all government bonds are risk-free. And in case you're struggling with that notion, I have 3 words I'd like you to repeat every day for 10 days, and you will never use the word government bond and risk-free interchangeably. Say Greek government bond, Greek government bond, Greek government. And after the 10th time, you will never make the mistake saying, if it's a government bond, it must be default-free. So not all governments are default-free, which means I've now opened a door to estimating risk-free rates in some currencies where I have to do some work. So the way I'm going to frame the risk-free rate discussion is take you through a series of 5 questions about risk-free rates. And by the end of this process, hopefully, you will have a template for thinking about risk-free rates. So I've kind of laid the foundation to how to think about risk-free rates. And I said in valuation, we estimate cash flows for a long time. A duration is a long-term duration. I'm going to give you a choice. Let's for the moment assume the US Treasury is default-free. We'll come back and ask what if that's not true. Let's assume the US Treasury is default-free. So here are the choices, and you tell me which choice you would make as your risk-free rate in your valuation. A 3-month T-bill rate, a 10-year T-bond rate, a 30-year T-bond rate, a TIPS rate. Is everybody familiar with how an inflation-protected treasury works? Right now, an inflation-protected treasury rate is about 0.8%. You think, why would I invest in something with a 0.8% rate? The 0.8% is guaranteed, but next year, here's what you get. You get 0.8% plus whatever the inflation is next year. So next year, the inflation is 1%, you get 1.8%. If inflation is 5%, you get 5.8%. See what I've given you? I've given you a rate that you're going to make in real terms that's guaranteed. The actual rate you make might be very different. And finally, maybe the answer is none of the above. Of course, if you believe the US Treasury has default risk, the answer is none of the above. But if you accept this assumption that the US Treasury has no default risk, which of those rates should I use? I've kind of given away the answer, but humor me anyway. We said valuation is cash flows that go for a really long time, so you want to go with the longest term rate. Every valuation you will see in this class, including the Apple and Amazon valuation that you've already seen, I use the 10-year bond rate. So let me step back. If this entire game is about getting the risk-free rate right, I would use the 30-year bond rate. The longer the term of my risk-free rate, the more it makes sense in a valuation because everything is long-term. But here's the problem. That risk-free rate is part of a much bigger game. I use that risk-free rate to estimate a cost of equity and a cost of debt. And to get a cost of equity, I need an equity risk premium. And to get a cost of debt, I need a default spread. You think, so what? If I define my risk-free rate as 30-year treasuries, then I have to define the equity risk premium as the return I earn over a 30-year treasury, and the default spread as a default spread on a 30-year corporate bond. Let me take that second half of the equation. How many 30-year corporate bonds do you think there are out there? Very, very few. If I pick the 30-year rate as my risk-free rate, I'm getting a better estimate of the risk-free rate, but the rest of my life got really messy. And if I have to step back and say, I have to finish this whole valuation, I'm going to go with the 10-year rate. So if somebody says, why are you using the 10-year rate? Doesn't the 30-year rate make more sense as a risk-free rate? The answer is absolutely. But then say, look, if I think about the entire process of estimating cost of equity and cost of debt, if I use the 30-year rate as my risk-free rate, estimating those spreads and equity risk premiums just got a lot more difficult. So I'm going to stay with the 10-year government bond rate. And as I said, when you do that, you are implicitly assuming the US Treasury is default free. You're saying, who would ever contest that assumption? I know most of you are probably too young to remember this, or maybe you were just coming out of college. But in 2012, S&P downgraded the US government. It was a huge event because the US government had always been AAA. People assumed it would be AAA forever. S&P lowered it from AAA not to double B or something, but to AA plus. You'd have think the world had ended. Now, I don't know, I was on a vacation somewhere. I started getting calls from, what do we do now? As if, we have to go back to ground zero. It is entirely possible that one of these days we will have to grapple with what to do with default risk in the US Treasury. I'll give you a template to do it, but for the moment, if you assume the US Treasury is default free, which is what I'm still assuming, the 10-year T-bond rate is going to be my risk-free rate. That was the easy one. Let's move forward. How many of you are planning to value European companies? Okay. Who are you valuing? Do you have a Diageo? Okay. Where is it incorporated? What currency are you planning to do the valuation in? Okay. Anybody? I'll come back to pounds in a moment, right? Because pounds are very interesting. It's actually, I had to make the transition that we just talked about in the US dollar. 10 years ago, if I wanted to risk-free rate in British pounds, what would I do? I'd look up the 10-year gilt rate and use it. Today I can't do that. Why not? The UK lost its AAA rating on every single rating agency. It's now down to AA. So there is default risk. We'll talk about what to do. Anybody planning to value a company in euros? What are you doing? Sanofi. Okay. Okay, so let's stay with that. Okay? So you want a risk-free rate in euros. What do you need? A government bond rate, right? Let me go find some government bonds. These were at the start of 2019. 10-year government bonds all denominated in euros. We have a problem. Right? They're all government bonds, but they range from 0.2% to 4.29%. So let me go to France. You're looking at a French company, so you're feeling this temptation to go with the French government bond, right? But maybe you're not that tempted. So what would you use as your risk-free rate if you're valuing the French company in euros?
I would actually try to look at where most of the revenues.
You've already made a currency choice. You can't go and look at it because here's the thing. What did we say about a currency? That we want something default-free. These are all 10-year government bonds, all in euros. So what's the only reason they're going to be different? It's just not 1998. The government bonds have all been different, but your French francs and lira and these are all in euros. The only reason for difference is across government bond rates is default risk. So the French government bond is a 0.68% rate because there is some perception of default in the French government. So I've given you the clue. So if I'm valuing a French company in euros, what rate should I use? You don't seem that convinced, but you would actually use the German euro bond rate. What if you're doing a Spanish company in euros? What if you're doing a Greek company in euros? You're saying, but I want to punish this Greek company for being Greek. I'll give you plenty of chances to do that. You can't do it in the risk-free rate. There's a risk premium waiting for you where you're going to come in and put in a higher risk premium. My point is, don't let the risk-free rate carry the burden of risk. It doesn't even make sense to have a risk-free rate with a 0.48% default spread in it. So if I'm valuing any company anywhere on the face of the earth, a Russian company in euros, my risk-free rate is going to be 0.2%. And in fact, there are some people who argue that even the German government is not quite default-free. Generally, when people assume that governments are default-free, what's the reasoning they use to tell you why governments should not default in their own currencies? What's the power that governments have that you and I don't? Hey, you have a student loan coming due. You can't go into the basement and say, let me run the printing machine a little. You wish you could. Governments are viewed as default-free, not because they're incredibly efficient economic operations. They're not. It's because they control the printing presses. So The pushback you get is, why would a government ever default? Why would an Indian government ever default in rupees? And my answer is empirical. Over the last 30 years, half of all sovereign defaults around the world have been in local currencies. So why would a government which has the power to print money choose to default? It's true, you can print the money, pay off the debt, because it's a choice between a rock and a hard place. The rock is default, the hard place is debasing your currency. And you know what? We've learned from looking at Latin America, that's like let's face it, Latin America is the epicenter of sovereign defaults. You can go back 200 years, red zone, red zone, red zone, red zone. Okay? What we've learned from Latin America is that it's easier to come back from default than it is to come back from debasement. I went to Brazil for the first time to do evaluation. I've gone to Brazil pretty much every year for the last 22 years. First time I went to Brazil was in the mid-90s, right after, 4 years after the hyperinflation. Okay? Only question I got for 2 days evaluation is, what's inflation going to be? What do you think inflation is? I have no idea. Why do you keep asking me this question? But you can see why it was front and center. But here's the damage it did. It took 15 years after hyperinflation had passed before any entity would issue long-term bonds in reais, because nobody would buy a long-term real-denominated bond because they'd been burned so badly by inflation. The Brazilian government did not issue 10-year bonds. And when they wanted to borrow money, they borrowed money in dollars. That's the effect of debasement. 3 years ago, I was in Argentina. In any just world, nobody should invest in Argentina. How many times has Argentina defaulted in the last 15 years? It's like having a crazy alcoholic uncle in your attic who keeps coming down, doing crazy things, and going back up there again. Right? 2015, though, they were in the glow again. Portfolio, foreign, because they had this moment, because they've defaulted 3 times, and 3 years later, people seem to have forgotten. They're all coming back to Argentina. The lesson that governments have learned out of this is you can default and come back. But if you debase, it takes you a long time. So the bottom line is, you can have sovereigns default, and in the euro especially, since you don't control the printing machine, even Germany can default. So there is an argument that maybe I should use the ECB, which is Europe, and that rate is so close to the German rate, and it's so much less liquid that I go with the German rate. So the risk-free rate in euros is going to be the German euro bond rate. Let's keep moving. Now let's make things difficult. Let's suppose I want a risk-free rate in Indian rupees. I find a 10-year Indian government bond, January 2019. The rate on that bond was 7.43%. So if I want to value an Indian company in rupees, I'm home free, right? I've got an Indian government bond rate. But before I use it, what do I need to check? Is there any default risk in the bond? And I'm going to cheat. And I'll give you another way in which you can check to see whether the cheating works. I went to the Moody's website and I clicked on sovereign ratings. All the ratings agencies have this. And Moody's rates 143 countries. And actually it gives 2 ratings for every country. A foreign currency rating and a local currency rating. You're saying, what's the difference? The foreign currency rating is the default risk that Moody's sees in India when it borrows money in US dollars or euros or Japanese yen, a foreign currency. The local currency rating is the default risk that Moody's sees in India when it borrows money in rupees. And I said, please God, let it be a AAA rating. Because if it was a AAA rating, you know what I'd have planned to do, right? I'd have used the 7.43% as my risk-free rate and blame Moody's if something went wrong. But I had no such luck. The actual local currency rating for India was Baa2, which is actually much higher than it was 10 years ago, 20 years ago, Baa2, which means that at least according to Moody's, I know the ratings agencies might not be the sharpest knives in the drawer, but eventually they get there. So they're a little delayed, but they do capture sovereignty. According to Moody's, there is a chance that India will default, and they've attached this rating. So let's think of an algebra problem. I have the government bond rate, 7.43%. What's troubling me? Some of that 7.43% is for default risk, and I want to find a way to get it out. I gave you the rating, Baa2. So what's the last thing I need to do? If I can somehow take the Baa2 rating and convert it into a default spread, I should be able to take that out of so in this case, let's assume, I'll tell you how I do this, because at the start of every year I have a lookup table on my website where you tell me the sovereign rating, I'll tell you the default spread. The default spread I had for that rating was 2.15%. So let's step back. Here's what the problem looks like. The Indian government bond rate is 7.43%. But at least according to Moody's assessment of sovereign default risk, the default spread in that bond is 2.15%. So what's the risk-free rate in Indian rupees? I'll give you the choices. You can stay with the 7.43% because you think government bond risk-free. That, of course, is extraordinarily dangerous. Imagine doing this for the Nigerian government, right? Or governments with far more default risk. Second is you can add the 2.15% to 7.4. I don't know why you would ever do this because it seems like you're double counting it. Or you can subtract it out, and to me the answer seems to be a pretty straightforward one. So I'm going to take the 2.15% out of the 7.43% and come up with a risk-free rate of 5.28%. Now do you see what you'll have to do in US dollars if the US government lost its AAA rating? You'd have to start with the T-bond rate. You have a little work to do. It's not the end of the world. In fact, you could live in a world where nothing is riskless, and we're getting awfully close to that point in this world where you might have to do this with every government bond to clean up because you want something truly risk-free. And I'll tell you why I do this. I do this because I think if I do not do this, I often double count country risk. I'll use a more egregious example to illustrate this. But 3 years ago, I was in Nigeria valuing PZ Cousins Nigeria, Nigerian consumer product company, Nigerian Naira. I wanted to get my hands dirty. The Nigerian government bond rate was 15.5% in Naira. The Nigerian government had an awful rating. The default spread in that for the Nigerian government is about 5%. So let's play along. Let's assume I will go with the conventional practice, using the government bond rate as my risk rate. I'm going to start with 15.5%, right? Then I'm going to come up with a risk premium for Nigeria, and if I adopt conventional practice, guess what that risk premium is going to look like? A really high number, often based on that same 5% default spread, because it's often risk premium. So I'm going to take a rate that's actually not risk-free, that has a default spread embedded in it, and on top of that I'm going to put a risk premium that has the same risk counted again. I think people count, or double count, or triple count country risk all over the place. And this is my maybe sloppy attempt to make sure that doesn't happen. So if you're given a currency where there is a government bond and the government bond is trustworthy, then you could potentially come up with a risk-free rate. So let me talk a little bit about where you would go, because the key number here is the 2.15%, right? Because you're not going to be able to see that on Bloomberg, or the 7.43% is observable. Saying, how do I come up with the default spread? Here are the three ways you could do it. The first is if you have a government that issues bonds in US dollars. For instance, much of Latin America, Brazil, Peru, Venezuela, not Venezuela because they've stopped issuing bonds, nobody will buy them, okay? But Brazil and Peru and Colombia and Chile, the governments issue bonds in US dollars, in addition to issuing bonds in the local currency. You're saying, how does that help me? Let's assume that the Brazilian 10-year government bond rate is 4%. That's in dollars. How do I use that to come up with a risk-free rate in dollars? I cannot compare a real rate to a dollar rate. Those are apples and oranges. But if you gave me the 10-year dollar rate for the Brazilian government is 4%, and the T-bond rate is, let's say, 2.6%, that difference between the 4 and the 2.6% is a default spread. So the first way you can get a default spread is if you have countries that issue bonds. It has to be in dollars or euros, some currency where I can get a risk-free rate. The second, the problem, of course, with that is you are trusting a government bond which might have special features, it might not be liquid. Here's a second choice, and this was not available until about 10, maybe 15 years ago. Have you heard of the sovereign CDS market, credits default swap market? It sounds fancy, but it's an insurance market, and here's how it works. Let's say you buy a Brazilian bond, and you worry about default risk. You say, look, I want to insure myself against default risk. So let's say the Brazilian bond is a 4% rate. And they might default. You go to the sovereign CDS market and you buy insurance against default. You buy. So what are you going to be required to do? You've got to pay. How much do you have to pay? That's what the spread is. So let's say the spread is 1.6%. What that means is you're going to collect a 4% coupon each year. You've got to pay 1.6% to the person who sold you the insurance, and you're protected against default risk. The sovereign CDS market is a market set estimate of the default spread for a country. The advantage is it moves all the time. So if something happens in your country, if there's a coup in your country, the sovereign CDS spread will reflect it immediately. The ratings agencies might take a while, but you'll have a market set number. The plus is it's constantly updated. The minus is it's a market set number. So people often overreact. Sometimes entire regions get knocked down for no other reason than one country in the region isn't having trouble. But it's good to have that second look at default risk in your company. So you could look at a government bond. If you have a dollar-denominated bond, you could look at a CDS market. But if neither is available, then you're kind of stuck. Then you look to see whether you can find a sovereign rating. I told you 143 countries. There are 70 countries for which I can get sovereign CDS spreads. There are about 25 countries where I can find a dollar or euro bond. So I went from 25 to 70. But for 143 countries, I can get ratings. And if I can get a rating and I can somehow convert that rating into a default spread, I can use that default spread. So rather than talk in abstractions, let me take an example at the start of 2009 and work it through. So at the start of 2009, I went and found as many currencies as I could which had a 10-year government bond rate. Let's face it, most currencies, there is no 10-year government bond. You're saying, how does the government borrow? It borrows from the World Bank. It borrows from some entity. It doesn't issue bonds. So there are about 40 plus currencies in which I can get a 10-year government bond rate. So that's my starting point. So let me focus on Brazil. The Brazilian real, the government bond rate was 9.18%. That's a government bond rate, not a risk-free rate, but that's my government bond rate. You can pick any other country you want, Indonesian rupiah, Kenyan shilling, you can see the government bond rate. To get to a risk-free rate, I need a default spread. So let me stay with Brazil and see what that default spread would be using all three approaches, because with Brazil, I can use all three. The first was I look for a 10-year government bond, and at the start of 2018, the Brazilian 10-year bond had a rate of 3.98%. So it's a traded bond, it's in dollars. The T-bond rate was 2.68%. The difference between the two gives me a default spread of 1.3%. So that's the default spread based on the government bond. Let's move on to the sovereign CDS market. In the sovereign CDS market, the CDS spread for Brazil was 2.87%. So clearly the CDS market sees more default risk than the people who are buying or selling the dollar-denominated bond. That rate is 2.87%, but there's a catch in the CDS market that might make that 2.87% an overestimate of the default spread, and here's why. Normally when you buy insurance, you expect the person who sold you the insurance to deliver if things go bad. And in most forward and futures markets, the exchange acts as the guarantor of the contract. They make sure that they collect money along the way. The CDS market does not have that mechanism. So when you buy insurance in the CDS market, you think you're protected, but you're protected only if the insurer has the money to deliver. In fact, the CDS market, the sovereign CDS market almost collapsed in 2008 because Lehman was one of the biggest sellers of insurance. Can you imagine buying your insurance from Lehman and Lehman is gone? So you're saying, so what? So when you see the sovereign CDS spread, part of that sovereign CDS spread you can think of for essentially the credit risk of the fact that you will not get paid. So what that means is the 2.87% is probably too high a number because some of it is really capturing the friction in the market. So here's what I do to clean up the 2.87%. Notice there isn't a single country with a zero CDS. In fact, the countries with the lowest CDS, US, Switzerland, are about 0.3%. So I'm going to make an assumption. I'm going to assume that some of these countries have no default risk, and what you see as the CDS spread is a reflection of that friction. That 0.3% is a measurement. I know it's a leap, but I'm going to take that 0.3% out of the 2.87% to get a cleaner measure of the spread. If you don't like that process, just stick with the 2.87%, but I'm trying to clean it up to make sure I'm truly getting a default spread. So let me pause right there. If I asked you what the default spread for Brazil is at this point, you can say it's either 1.3% or 2.57% if you net out the spread. I'm not quite done. Let's try the third approach. Third approach, I take the rating for Brazil, which is Baa2, and this is the lookup table that I updated at the start of this year. So Baa2 rated, so I've given you both S&P ratings and Moody's ratings depending on which rating you have. A Baa2 rated country has a default spread of 2.15%. we have, this is actually a multitude of riches. You wish you didn't have this. You say, well, if I had one number, I could move on. Brazil, you have three numbers, 1.3, 2.57, or 2.15%. You're saying, which one should I use? I'm going to say something that's going to sound odd. It doesn't matter. Just pick one and stay consistent. That sounds odd for the following reason. Depending on which one I use, I get very different risk-free rates in reais. If I use the government bond spread of 1.3%, my risk-free rate in reais is 7.88%, 9.18 minus 1.3%. If I use the 2.57%, my risk-free rate is 6.61%. And if I use 3.39%, I'm sorry, Brazil had a BA2 rating. I said BAA2, it's BA2 rating. The spread is actually 3.39%. The risk-free rate is 5.79%. Holding all else constant, which one should give you the highest value then? Getting the lowest risk-free rate will mean you're building off a lower base. So let's go with the rating base spread of 3.39%. Here's why it doesn't matter. This is just your risk-free rate. Later on, I'm going to come and ask you for a measure of the country risk premium in Brazil. And guess what? You're now stuck. You can't change your mind at this point. So let me use the 1.3%. So use the 3.39% as your default spread to get your risk-free rate. That 3.39% will now become the default spread from which I build your equity risk premium. What one hand gives you, the other hand will take away. What will get you into trouble is if you use the 3.39% at this stage, and then when you get to the country risk premiums, you use some service that use the 1.3% as the base. And you can see how easily that can happen, right? Because you're drawing numbers from different places. Just be internally consistent. A lot more work to get a risk-free rate in reais than it is to get a risk-free rate in US dollars. Yeah. Your stock market will not even tell you what the risk premium is. So
exactly. So I will just use a CAPM RF plus.
No, wait. The CAPM just requires, so where in the CAPM would you expect to do it? Your beta can't carry the weight.
Exactly.
So it's got to be in the risk premium.
So I will add on top of that.
Exactly. That's what an equity risk premium will do. It carries the burden of how much country risk you have. And that number will vary in different countries. So that's where we're going, and that's exactly why you need to be clean about the risk-free rate, because when you get to that risk premium, you're going to feel this urge to use a high risk premium for risky countries. And if you're building off a risky currency, you might have double counted the risk. Betas have to average around 1. You cannot show country risk in betas. The average beta across all Indian companies, all Nigerian companies, all African companies, you pick any of the riskiest parts of the world because betas scale to the average risk. Your beta can't carry the burden of country risk. It has to be in the risk premium, no other place to go. Now just, yeah, go ahead. We'll talk about that because in a sense I can see where your mind is going. You can end up with a negative risk-free rate. That's kind of freaky, right? When we did our Econ 101, we never saw it. For the last 5 years, people have been freaking out about negative risk-free rates. The Swiss franc rate, you know what the 10-year bond rate is right now? Minus 0.2%. There was a time in the Netherlands a couple of years ago where if you borrowed a house, borrowed to buy a house, the bank paid you. It's kind of mind-boggling. You say, what? It's not the way the world is supposed to be, but guess what? We've got to live in the world we're in, not the world we wished we were in. We live in a world with negative risk-free rate, and we're going to see why that can happen and how to handle it. Okay? Let's finish up a few more loose ends before we do that. Let's assume, yeah, go ahead.
You should get the same value, whatever you use it. Like if I'm consistent,
Yeah.
we should like.
You could get roughly, with this one you might not get the same value, but you should get roughly the same value because if your beta is much higher than 1 or much lower than 1, the value can be different. But no, it's not going to make or break your valuation. That's all. Yes? We'll come to that. There's a whole set of countries. Did everybody get the question? There are countries which have pegged exchange rates. All through the Middle East, for instance. People value companies with the US dollar rate as the risk-free rate. The argument being that all these currencies are pegged, therefore we should be able to use the risk-free rate in the US. Yeah, in Argentina I did the same thing, but this too shall pass, right, at some point in time. So you've got to be careful when you're not in control of your currency, whether your fundamental, some countries you can get away with it because the fundamentals support it. We'll talk about what that fundamental is you got to look at before you decide to go with the T-bond rate as your risk-free rate. Right? Because there are cases where you've had, you could use dollars in your transaction, but then it all blows up, and we'll talk about what it is that causes those things to happen. Let's say you want to get a real risk-free rate because you're doing a real valuation. And I talked about the TIPS rate as an estimate of the real risk-free rate, 0.8%. And I've heard people say, well, that's a US dollar real risk-free rate. Remember, when you talk about real risk-free rates, you no longer have currencies. A real risk-free rate is currency-free. Let's suppose and nobody values companies in real terms in the US. It doesn't make any sense because it makes your life so much more difficult for taxes and other purposes. So the countries where you're going to use real valuation, valuing things without inflation, are countries in Latin America, parts of Africa, and you're not going to find a government, inflation-protected government bond in that country. So here's my question. Make my life very easy. If I could take the 0.8% that I have, or 0.88% that I have in the US, that I got from the TIPS market, and use it as my real risk-free rate wherever I am in the world, it would make my life easy. And there is actually a set of conditions where that's going to be okay. Step back. Let's go back to the Econ 101 class. If you lived in a world where capital can flow freely across markets, I know we don't live in that world, real risk-free rates have to converge around the world. Do you see why? Because about a 5% real risk-free rate in one part of the world and a 2% real risk-free rate in another part of the world, what should happen? Money will leave the 2%, go to the 5%. So if you make the assumption, it's a very strong one, that capital flows freely, you can do your valuations using the 0.88% as your real risk-free rate. But of course, if there are capital frictions, you can end up with high real risk-free rates in some parts of the world and lower real risk-free rates in other parts of the world. And estimating it is messy because you can't use the local government bonds to do it. We'll talk about tricks you can do to get around it. But if you want a risk-free rate, a pure risk-free rate, the closest thing right now we have is the TIPS rate, the 0.88%. Okay. Few more loose ends, and then we're done with risk-free rates. Remember, for all those government bonds that I showed you with the 40 currencies, there was a government bond rate. Now, when we talk about the UST bond, we're talking about one of the deepest and most liquid markets in the world. Okay. But when you're talking about the Indonesian rupiah government bond rate, you're talking about a really shallow market where you might have no trading at all. And in some of these markets, there's absolutely no trading. The government actually sets the bond rate and forces people to buy that rate. You see, how can they force people? Banks are required to buy the government bonds because it's counted as part of the regulatory capital. So you see where I'm going? Maybe the government bond, for instance, if you looked at the table, it says that the government bond rate for Venezuela is like 19.5%. There is zero chance that that is true. Zero. You know why? Because what is the inflation rate? Like 500,000%. You would never buy a bond at 19, unless the Venezuelan government puts a gun to your head, and that literally and physically, and saying, buy the bond. So even among those government bonds, there are some government bonds you look and say, oh, I don't know whether that's right. And there are about 100 currencies where there are no government bonds at all. You think, what do I do to get a risk-free rate in that currency? Here are your choices. One is, you can try to get a local risk-free rate, but as I said, without a government bond, that's tough. The second is you can try to do things in real terms, because then you don't have to bring inflation in. But we talked about how difficult it is to get a real risk-free rate if you're outside in one of those markets. Or you can cheat. You can value any company in any currency. So rather than sit there and wrestle with the Russian ruble and try to figure out what a risk-free rate is in rubles, I can value Gazprom in US dollars. I like to value companies in the local currency because to me it seems like an admission of failure not to do it. But if I'm spending a week trying to come up with a risk-free rate in a currency, maybe the better thing to do is move to a different currency. It doesn't make the problem go away. I tell people if you have high inflation in your currency, it's like having an elephant in your living room. You can cover it up with a big blanket and say, I don't see an elephant, but every time it moves, you will notice. And with inflation, that's the problem. Is you're trying to run away from it, saying, there's high inflation in my currency, so I'm going to do everything in US dollars. But guess what? It might not be in your risk-free rate anymore, but your exchange rates are going to reflect it, right? So the problem just moves around in your valuation. But sometimes it's prudent to switch currencies and do everything in a different currency. But I'll give you a trick you can use to actually get a risk-free rate in any currency in the world. And to understand the trick, I'm going to show you a graph. Okay? I'll come back to the trick. I'm going to show you a graph, and I'll come back to the trick in a moment. Okay? I'm going to show you a graph, and I want you to answer a couple of questions about this graph. And embedded in this graph is the issue you raised about negative risk-free rates. So these are my estimates. So the green numbers are my estimates of the risk-free rate in about 40 currencies from the government bond rates. So let's start with the obvious. Risk-free rates vary across currencies. Notice government bond rates can vary across, but these are risk-free rates vary across currencies. Why? What causes risk-free rates to vary? Because if you can answer this question, you cracked what I call the currency code. You'll never have trouble with currencies after that. So what causes the risk-free rates to vary across currencies? Wrong answer, because it's risk-free, and I've done my work, that risk can't be one of the answers, right? Because it's truly, the government bond rate can vary because of political risk. But if I've done my work and I've cleaned up for the risk-free rates, the one and only variable that causes currencies to have different risk-free rates is differences in inflation. If you're a high inflation currency, you're going to have a high risk-free rate. You have a low inflation currency, you're going to have a low risk-free rate. If you have a deflationary currency, what could you have? You could have a negative risk-free rate. So if somebody asks you, are negative risk-free rates possible? Yes. They're unusual but not unnatural. They're unusual because you very seldom have a currency with deflation for the extended period. But if you did, and therein lies the answer as to why currencies don't matter. So let's assume I value a Brazilian company in Brazilian reais. I have high inflation in my discount rate, right? That's pushing up my discount rate. But what's happening to my cash flows since I have to do them in reais? The same high inflation now is going to help me on my cash flows. When I do growth rates, I have to do them with inflation embedded in them. So my cash flows will have high inflation, my discount rates will have high inflation. And if I switch to US dollars, it's true my discount rate will get much lower because I have low inflation, but I can't keep using the growth rates I did before because those were real growth rates. I've got to convert them to US dollar growth rates, which will be much lower. As long as you stay consistent, things will work out. I have a valuation of Henkel, Swiss company, a German company in euros with a negative risk-free rate. There was a time when, and I remember when, as I did the valuation, people were saying, you can't do that. I said, well, I can do whatever I want. It's but they said the risk-free rate is negative, the discount rate is going to be really low. I said, you're right. But you know what, it'll take care of itself. And then they looked at the growth and said, why are you giving me such a low growth rate? He said, why do you think the euro risk-free rate is so low? It's not a sign of a healthy, vibrant, growing economy. It's a sign of deflation and low growth. Risk-free rates are not just mechanisms from demand and supply that you look up. They reflect the underlying economics there. And this is what I'm going to use as my trick to come up with a risk-free rate in a different currency. So go back to the previous page, the page I jumped by. Because I'm going to give you a way of getting risk-free rates that is generic. You can use it in any currency. So let's assume our currency, we either don't trust the government bond rate, or you don't have a government bond rate. Here's the first way you can try to get risk-free rates. You can start with the expected inflation in that currency. You're saying, where am I going to get that? The IMF actually has predictions of inflation. They're all going to be wrong anyway, but the key is to be consistent. If you're wrong in the same direction in both your discount rate and your cash flows, you don't have to worry about it. So you got inflation plus a real risk-free rate. See, where am I going to get that? Use the TIPS rate as your real rate. That's the first. Here's the second, and this is an even more convenient way of doing it. If you ask me what the US dollar risk-free rate is, I feel pretty comfortable in saying it's about 2.65%. So let's suppose you want a risk-free rate in Egyptian pounds. There's no government bond in it. But then I say, you know what, inflation in Egypt is 15%. You see how you can use that to come up with the risk-free rate in Egyptian? If the reason for differences between currency risk-free rates is a difference in inflation, if the risk-free rate, if the inflation in Egyptian pounds is 15%, but the inflation rate in US dollars is only 1.5%, your risk-free rate in Egyptian pounds is going to be roughly 13.5% higher than the dollar risk-free rate. That's if you're in a hurry. If you really want to do this right, there's a compounding effect. So it sounds fancy, but instead of just adding the 13.5, which would give me 15 point something percent, you take the compounded number. Okay? The compounded number reflects the fact that you are in fact coming up with a risk-free rate that builds on top of your real interest rate. So if you want a risk-free rate in a currency, you can get it. You can get it if you're willing to start with the US dollar and make that expected inflation differential. Now let's turn to the question about Ecuador and pegged exchange rates. And I'm going to frame this in terms of the Middle East, where it's a much bigger issue. For decades now, they've been using the T-bond rate as a risk-free rate because the currency is pegged. Currencies are pegged by governments, right? And they get unpegged when you can't maintain the peg anymore, which is what happened now. It's happened in other countries. So think about what it is that causes pegs to blow up. If I peg a currency to another currency, what has to be true about the inflation rates in the two currencies for the peg to survive? Inflation has to be roughly the same. If your inflation rate is 10% and the US dollar inflation rate is 2% and you peg your currency, it's like filling a pot with water, putting a lid on it, turning the heat up, and sooner or later it's going to blow. It's going to blow because you have fundamentals that don't support the peg. I think that in the Middle East, people have to give up this practice of using the US dollar risk-free rate because the inflation rate in Saudi Arabia is close to 4.5% now. Why? Because they've had, with the oil prices down, they've had to kind of do things on the side which have pushed up. And if your inflation rate is 4.5%, continuing to use a risk-free rate that has a 1.5 or 2% inflation embedded in it will lead to what? Overvaluing companies or undervaluing companies? You're going to overvalue every company because you're going to be feeding the 4.5% inflation to your earnings and cash flows, and then you're going to be discounting back at a discount rate that's built on the presumption that inflation. Do you see how subtle this mix-up is? It's so easy to slip up. Why? Because we're not careful about currencies. We think 3% is lower than 7%. Of course it is. Is it? Is it cheaper to borrow at 3% in US dollar terms as opposed to 7% in Bangladeshi rupees? No, because in a sense, inflation is the variant. And I'll give you an analogy. It's going to be a kind of a simplistic analogy, but it kind of brings home why it's so dangerous to not be explicit about currency. Last year I had to fly from San Diego to Frankfurt. So when I left San Diego on my Lufthansa flight, I checked my iPhone for the temperature. It said 70 degrees. It's always 70 degrees in San Diego. I don't even know why I checked. I landed in Frankfurt. I checked my iPhone. My iPhone is really smart. And also it tracks me all the time. It seemed to know where I was. And I asked what the temperature was. It said 28 degrees. I thought I'd landed on the North Pole. The difference was, when I left San Diego, the prevailing measurement, we used Fahrenheit, and we landed in it magically. If I ask you what the average temperature is across the two cities, you don't add 70 to 28 and divide by 2. You could, but it would be a meaningless number. And that's exactly what happens when you mix and match currencies. Okay? So be explicit about currencies, come up with a risk-free rate, then move on. This is not worth, kind of wrestling with. So let's go back to that starting question I had about risk-free rates being low and the Fed being responsible for keeping rates low. In fact, this got carried into practice. So I'll tell you one of the things that started happening in valuation, because people perceived the Fed to be keeping rates unnaturally low. They said, I can't use today's risk-free rate, it's too low. I will use a normal risk-free rate. You're saying, what's normal? I tell people, you tell me how old you are, I'll tell you what will look normal to you. You say normal risk rate. Yesterday I read an article that said a normal T-bond rate is about 7%. And I said, you must be at least 75 years old. You probably came into the market in 1977. You know that there is behavioral studies that say what you see around the age of 35 becomes your definition of normal from that day on. I'm not kidding. It's actually, so if you came in the 70s or 80s, 7% is what you came through, so that's normal. You came in the 90s, it's 5%. You came in 2008, you think 2.6% looks a little high to you now. So already normal is in the eye of the beholder. Let's say this guy is 55 years old. And he says, you know what, I'm going to replace today's risk-free rate with 5.5% because that is the average T-bond rate over the last 25 years. Sounds like a prudent thing to do, right? Rates could go up. Why not bring in a higher risk-free rate? Lead me through what's going to happen next. I build 5.5% as my risk-free rate in dollars. What's going to happen to my cost of equity and capital? They're going to be higher. And if I use a higher discount rate, holding all else constant, what's going to happen to my value? It's going to be lower. I'm probably going to find that everything looks overvalued. And then what do I plan to do? Invest my money at that 5.5% T-bond. The only thing, it doesn't exist. It's only in my head. Risk-free rates are not hypothetical. They're opportunity costs. What you and I think the rate should be is irrelevant. If I don't invest in stocks today, guess what I'm making? I'm not making 5.5, I'm making 2.68%. So even if you're one of those conspiratorial people who believe the Fed has kept rates low, let it go. This is not your rate and my rate. This is the opportunity cost. You might think it's unfair. This might think it's terrible. It's skewing things. But it is the alternative to investing in the company you are valuing. I think it's extremely dangerous practice to normalize. You can normalize margins. You can normalize growth. But don't normalize risk-free rates. So let me take head on this notion that the Fed has kept rates low. Let's start with some basic facts. Have rates been lower over the last 10 years than they have historically? It's an easy one. Absolutely. Okay? So let me show you a graph of T-bond rates in the US, and you'll see the T-bond rates low. But why have they been lower? Of course, the conventional wisdom is it's because the Fed has kept them low. But remember I said there are two numbers that go into risk-free rate, inflation and a real interest rate. I'm going to get the inflation every year. So in this graph, actually the gray part of the graph is my inflation rate every year. And then I looked up the real GDP growth every year, which is a rough proxy for the real interest rate. So what I've done is taken the inflation rate. So let's say the inflation rate is 2%, and real GDP growth is 2. 2 plus 3 is 5, and I'm going to say that's what, I'm going to call that my intrinsic risk-free rate. And I've graphed that. So the gray line is my intrinsic risk-free rate. So let me ask you a question. Does that gray line seem to move a lot with the actual T-bond rate? Yeah, it does. So if somebody asks me, why have rates been low for the last 10 years? Here's my answer. It's not because the Fed kept them low, but because we've had low inflation and abysmal growth. Low plus low is low. I'm a realist. I accept that the Fed can finesse rates at but at the margin. If inflation is 7%, I don't care how powerful your Fed chair is, your T-bond rate is not going to be 2.5%. But 5 years ago, I went with my wife and 2 of my kids to the Federal Reserve. They have a tour they take you. It's downtown. If you get a chance, go. It's actually fun. You go in and they take you on a tour of the building. The best part is when they show you the stacks of money in the basement. Don't get any crazy ideas and try to pull off a heist or something. So we walk in, and this 23-year-old, really nice person comes up to us. She was going to be our guide. And I almost made myself persona non grata with my first question. I said, could you take me to the interest rate room? Because from listening to CNBC, I was convinced that there was this room that Janet Yellen sat in, and she said, you know what, T-bond rate looks too low. I'm going to move it to 3.2%. The T-bill rate looks too high. Because that's the sense you get, that the Federal Reserve actually controls all these different rates. You know the only rate the Fed actually sets? It's not the T-bill rate. It's not the T-bond rate. It's none of the Treasury rates. It's a Fed funds rate. So my second question was going to be, you know what the Fed funds rate is, right? It's an overnight borrowing rate at which banks can borrow from the Fed. My second question was, can you take me to the Fed window? I'd like to borrow at the Fed funds rate, which is not going to work either. None of us will ever even get close to a Fed funds rate. So that's the only rate that they control. And through that rate, they hope, they pray that they can have all these percolating effects on the rest of the rate structure. But for that to happen, people must perceive that they have power. I call the Fed is a little bit like the Wizard of Oz. Its power comes from the fact that you think it has power. If you ever saw what was behind the curtain, it would terrify you. So we thought, oh, there's that powerful, right, behind the curtain. Ben Bernanke, Janet Yellen, Jerome Powell. They will make things right. It makes us all feel a little more comfortable but the Fed really doesn't set rates. It influences rates, and only so if it has some perception of power. You're saying, will it not always be perceived to be powerful? Take a look at the Japanese central bank. That is your nightmare scenario if you're a central bank. Because people have stopped caring, because they know it has no power. Because once your rates hit zero, and central banks in a sense are like, they've been a little insane over the last 10 years. Because the only trick they know is to get the economy going is to lower rates. I'll describe it to somebody who's trying to drive a gear shift car. It goes first to second to third to fourth and keeps going. The gear shift is out in your hand. And that's pretty much where central banks ended. They dropped the rates to zero and they kept going. They said, it's the only thing I know how to do. And of course, economies continue to do what they did. So if you're operating under the presumption that risk-free rates are low because central banks are low, I'd encourage you to rethink that. They have an impact, but I think the key for us is to look at the fundamentals. And that's going to be true for any currency. Step back and look at the fundamentals. So for Ecuador, I don't know what inflation is in Ecuador. Until I know that, I cannot answer the question, will this last? Because if inflation is high, then you're okay. And the reason you're okay is not because it's pegged, but because you have low inflation. In fact, you could do a synthetic local currency risk-free rate if one existed, and you'd end up with a rate very similar to the rate that you get with US dollars. See, but for the moment it is, right? And that's why I use the Argentina example. Late 90s, for instance, in Argentina, you could pay in dollars. You could actually pay in pesos. They'd give you change in dollars, right? So it was almost and people said, we're now a dollar country. The only problem is you don't control the printing machine. If Ecuador goes into a deep recession because it's stuck with the dollar, there is always, this is a government decision to be pegged. There can be a government decision to unpeg. So unlike a country where the currency is picked because you control the printing presses, Ecuador will be at the mercy of whatever the government decides to do. For the moment, it's okay. But if inflation goes to 8 or 10% and there's a recession, there's going to be this temptation to unpeg, because otherwise you're going to be dragged into the ditch and have no control over the process. I'd keep my eye on both inflation and how the economy is doing, because both of those things play into. So as long as the economy is doing reasonably well and inflation stays low, hey, the US dollar can be a risk-free rate. But if that starts to shift, then I'd start to worry. Question back there, somebody? No? Yep. No question? No. Okay. You said you had one question and no question. But even commitments are made by governments, right? Governments that commit can uncommit.
Right, but that's a lot easier to do when you're just...
Yeah, so maybe it'll be stickier in Ecuador than in Argentina because of the way it's been structured. Yeah, so I'm saying for the moment I'm okay using I'm going along with the dollar risk-free rate. I'm just saying you've got to keep your eyes on the fundamentals, because what causes commitments to be broken is economic crises. Okay? Because remember, even Greece committed to being in the euro in 99. They all committed, right? But then, things start to get... And the problem for Greece is because they committed to being part of the EU, they could not do anything about their own economy. So that's really the stress that builds up on any kind of commitment to use somebody else's currency. So that's the risk-free rate component of the discussion. Let's finish this off with negative interest rates. Now you can see why risk-free rates can be negative. If you have deflation, you have low growth, you can end up with negative risk-free rates, and it's okay. You can use those negative risk-free rates to come up with the cost of equity and capital. You will end up with low discount rates in Swiss francs. or Japanese yen, but you'll also end up with really low growth rates for companies. And the net effect is you're not gaining. In fact, I think it's unhealthy for an economy to have really low rates. I've told people this and they think I'm crazy. My measure of whether the US government is back to health from after 2008 is when T-bond rates at 3.5% to 4%. Until that happens, I think there's still something that's holding back the market. So so when you get currencies with close to 0% rates, I wouldn't celebrate, okay? Because it really is a reflection of an underlying problem with the economy that's showing up as low risk-free rates. I don't want 500% risk-free rates, so don't get me wrong. I want something that's low, but I don't want it that low. And so we'll try to value a couple of companies with negative risk-free rates so you see it play out. Let me at least start on the second number. So all this discussion was about getting the risk-free rate. Let's move on to risk premium. Let me first define what the risk premium is supposed to measure, and then let me talk about how people try to measure it. The equity risk premium is what you demand over and above the risk-free rate for investing in equities as a class. Let me repeat that again. Remember the T-bond rate is about 2.7%? It's what I would demand over and above the 2.7% for me to invest in equities. Why would I need to demand more than 2.7%? Because human beings are risk averse. If I invest in equities and make exactly 2.7%, I'm being exposed to risk and not being rewarded. So the struggle in every risk and return model, whether it's a CAPM, the arbitrage, is coming up with that risk premium because it has to be forward-looking and expectation for the future. You know how most people estimate equity risk premiums, at least in the US, and this practice is spread to the rest of the world? They look backwards. It's called a historical risk premium. It's not fancy. You take the last 50 years, you ask two questions. On average, over the last 50 years, what would I have made investing in stocks? Let me make up a number, 8%. So that's the annual return. Then second question you ask is, on average over the last 50 years, what would I have made investing in T-bonds? Say it's 5%. 8 minus 5 is 3. You say, if that's the risk premium I earned in the last 50 years, that is going to be my expected risk premium in the future. Let me pause right there. When I do that, what am I assuming about the future? It's going to look like the past. You're saying, what's wrong with that? It's called mean reversion. We assume that things revert back to a mean. It's a very powerful force, and it works, and works until it doesn't. You know what causes mean reversion to break down? If you have a system that's structurally stable, every time you deviate from the average, you're going to come back to the average. See, that's a big deal. Much of what we know in finance was developed in the US in the second half of the 20th century. And in the second half of the 20th century, the US was the most mean reverting, stable economy of all time in the history of the globe. It's almost like if you see global economic growth starting in prehistoric times. Let's say we're able to get a graph. If you look at that graph, it looks zigzag all the way to about 1945 to 50, and then it goes into like a coma. So you had an incredibly stable, you had things like recession lasts 6 months, at the end of 6 months, the hiring picks up. It's almost like you could do in clockwork. This is the way it works. So it's in that period that people develop this historical risk premium approach using US stock market data and say, you know what, if that's what you've earned in the past, that's what you can expect to earn in the future. Until 2008, I would accept, I didn't use historical risk premiums and valuations, but if other people did, I wouldn't push back too much because I said, you know what, you're doing what you were taught to do. You're assuming the US is a stable, mean reverting market. I cannot directly counter that right now, though I'm feeling uncomfortable. So if you want to use historical risk premium, that's your choice. I no longer take it that passively because post-2008, I think it's untenable to assume that things are going to revert back to the way they were in the 1960s or 70s or 80s. 2008 to me was a break in the system. It was a reminder to all of us that we moved on from an economy that was 50% the US and the 50% everybody else to a truly global economy, everybody connected to everybody else. So my first problem with historical risk premiums is a philosophical one. You can't assume mean reversion if the basic structural model has changed. Here's my second problem. It's a statistical one. In statistics, when you compute an average using 60 numbers, What are you trained to put in brackets below that average to tell the word how uncertain you are about the average? A standard error, right? Basically saying, look, my average is 6.2, but by the way, my standard error is 0.4. And then you're taught in statistics that standard error allows you to come up with a range. So let's do some statistics with historical risk premiums. Because at the start of every year, I actually compute the historical risk premium for the US. It's not difficult to do. The data is all out there. My historical equity risk premium for the US could be any number from 3% to 13%. That's quite a range, right? You're saying, how can it be so different? It depends first on what slice of history I look at. If I go all the way back to 1928, I get a very different premium than if I go back 50 years or 10 years. It depends on whether I look at T-bills as my risk-free rate or T-bonds, short-term or long-term. It even depends on how I compute my average. You say, what do you mean, how do you compute your average? I could do a simple average, add up 60 numbers and divide by 60, or I can do a compounded average because money, a geometric average. I get very different numbers. I have 12 very different numbers, all of which are technically historical risk premiums. Do you see why equity research analysts love this table? What do we say was the driving force behind bad valuations? Bias, right? So when you're biased and you want to come up with a high value and you look at that table, what's the number you latch onto? The lowest number you can find, because the low risk premium pushes up your value. If on the other hand, you're on the other side of the spectrum, you're going to go with the highest number, say, look, 13% is the risk premium. Technically, neither of you is lying. But from the perspective of valuation, you're both lying. Because every one of these numbers is an estimate with a standard error. You're saying, how big can the standard error be? If I go all the way back to 1928, that's 90 years of data, my standard error is about 2.22%. Let me try some pure statistics, and you tell me how comfortable you feel. My historical risk premium, if I go all the way back to 1928, is 4.66%, second decimal point. My standard error is 2.22%. What's the rule in statistics? If you want to get a range with 95% confidence, you add or subtract about 2 standard errors, 1.96, 2 standard errors. Which means my true risk premium for the US could be somewhere between 0 and 9%. Fat lot of good this does you in evaluation. Use some number between 0 and 9. You could just have asked your doorman, what should I use, 0 to 9? No, that sounds about what you do. You'd have gotten. And that's using 90 years of data. You're saying, but remember, 90 years of data, I'm going back to 1928, 2 years before the Great Depression. You're saying that is so long, such a long time ago. Let's just use 10 years. Okay, 10 years, your risk premium is 11%. Nice round number this time. But the standard error in that number is 5.5%. Your true risk premium could be anywhere from 0 to 22%. 10 years in equity market history is a drop in time. 50 years is no time at all. Even 90 years is you need about 250 years of uninterrupted market history with the market not changing to get a viable. Good luck with that. Now do you see why historical risk premiums get used all the time but should never be trusted? In fact, one of the other problems with using US data is you have a survivor bias. Let me explain what I mean by that. You know what the most successful equity market of the 20th century was? It was the US, because it went from nothing to becoming the dominant economy. What am I doing here? I'm taking the most successful market of the 20th century. I'm looking to see whether I earned a pretty good. And what's the answer going to be? Of course you earned a big risk premium. You picked the right market. But for the next century, which is what I'm looking at for equity risk, I have no idea who the winner is going to be and the loser is going to be. Using the US equity risk premium, even if it were precise and even if the market's not changed, it's going to be potentially dangerous because you don't know what the next survivor market is going to be. So to counter that, about 10 years ago, a couple of researchers at the London Business School actually started computing equity risk premiums across. So basically you have this noise in the estimate and the survivor bias. So if you, roughly speaking, one way to think about that standard error you see is the typical standard deviation US stocks is about 20%. If you divide that by the square root of the number of years of data you have, you're going to get a rough estimate of the standard error. You have no idea what I'm talking about, right? If you have 100 years of data, square root of 100 is 10. 20% divided by 10 is a 2% standard error. You say, I want a 1% standard error. I'll let you work out the math. But you're going to see that very quickly why you need 253. I mean, the number of years, you probably need 1,000 years of data. Yeah. So historical data gives you a number, but the number comes with this huge range. So these two researchers at the London Business School computed risk premiums for a bunch of different markets. So this is to counter the survivor bias. They said, rather than just pick the US, we're going to pick the 22 biggest markets of the 20th century, and we're going to compute the risk premium in each of them. More sensible, right? In fact, the average they got across the entire world, looking across 1900 to 2017, 117 years, was about 3.2%. What was it just for the US? 4.66%. If you look at the entire world, it's lower. That's a measure of how much you're adding onto your premium by focusing on the most successful market. So it's historical risk premiums. People make them out to be facts, but they're clearly estimates with a huge standard error. Now, if you think about what I just said, I said you need a lot of data to get a risk premium, an equity risk premium, right? So about 2 months ago, I get an email from a Vietnamese equity research analyst. He just started on a sell-side equity research job. He said, I'm doing my first valuation. I'm terrified. Could you take a look at my valuation and tell me whether I've screwed up big time? And so he sends me the valuation, and I had some free time. I opened it up. He actually done a pretty good job on the company with one small problem, which is when he computed an equity risk premium for Vietnam, he decided to use a historical risk premium for Vietnam. How many years of historical data do you think I'll have in Vietnam? 150? He had like 6 years of data. And the first 3 you might as well throw out. So he'd taken 6 years of numbers because you can't blame him, because I blame the way we write our books, because we say, look, take a historical premium, we do the US, and then people take that and they take it to Poland, they take it to Vietnam, they take it to Cambodia, and next thing you know, you're using 2-year numbers to come up with an equity risk premium. So he'd come up with an equity risk premium, and I emailed him back saying, I like everything you've done, but you might want to compute the standard error in that 6-year return. It's not difficult, right? You take your Excel, you do. And 15 minutes later, he said, my standard error is 3 times my risk premium. What do? I said, don't look backwards. In fact, for a young market, you don't even want to look backwards. So he said, what should I do then? I said, you have 2 choices. You can wait about 90 years, get enough data, and then do your valuation. But then by then you'd be either dead or fired, or dead and fired, or fired and dead, or whichever sequence you go in. I said, you got to do something right now, and I sent him my suggestions on how to estimate country risk premiums. Because let's face it, 95% of the world, this is the problem you're going to face. You're not going to get reliable historical data. So I'll give you 3 different ways in which you can get a risk premium for a country. One is to use a number we've already used. Remember how I got a risk-free rate in a currency? I took the government bond rate. That same default spread, I'm going to take on and say that's a measure of additional country risk. I'm reaching here because I'm using a default spread as a measure of additional risk. And I'm going to add that on to my US risk rate. So assuming I have a base premium for the US, that's a big assumption, but let's say I can use 90 years of data for the US, and I come up with 5.96%, or 150 years and come up with 5. I'm going to add the default spread for so for Brazil, for instance, the default spread we got by looking at its rating was 3.39%. I'm going to add the 3.9% to the 5.96%, and my risk premium for Brazil is 9.35%. This is the state of the art, if you can even call it that, of how investment banks compute equity risk premiums in other countries. They start with the US base, and they add on top of it a measure of the default risk, either the CDS spread or the default spread from a government bond or a default spread based on the rating. And they dust their hands off and say, I have a risk premium for Brazil. That's the first approach, entirely based on the default spread. But you're asking for a lot, right? Because the default spread is what you're charging for buying a government bond. You're saying, I'm not interested in government bonds. How about equities? So let's end with these last 2 choices. The first is, stay with the equity market and do an algebra problem. The 5.96% is my equity risk premium for the S&P 500, the US. I'm saying Brazil is a riskier market. If I can give you a measure of Brazilian risk relative to the US, you should be able to come up with a risk premium for Brazil. So here's what I did. I started with the 5.96% my US premium. I looked up two numbers. One is the standard deviation in the Bovespa, the Brazilian equity index. Say it's 30%. The second is the standard deviation in the S&P 500. Let's say it's 18%. And I did an algebra problem. For an 18% market, I'm demanding a 5.96% premium. If my market had a 30% standard deviation, my equity risk premium should be higher. In fact, it's 9.93% scaled up. That sounds pretty promising, right? This is the Goldman approach to country equity risk. It has one fatal flaw. It's built around the standard deviation of the equity market. Using this approach, for instance, the Bangladeshi market should have an equity risk premium half the equity risk premium for the US. The equity market in Ghana should have no risk premium at all. Why? What is it based on? Standard deviation equities. For equities to move, what has to happen? You've got to have trading. If liquidity dries up in a market, standard deviation is going to disappear. You're thinking your market is safe because the standard deviation looks low. It's a really risky market. So the problem with latching on and comparing standard deviations across markets, developed and emerging markets, is you can get some strange looking results for country risk. So we'll stop there when we come back on there's no class on Monday. On Wednesday, when we come back, we will estimate a third way of coming up with country risk claims. Your question?
I just have a question. So why don't we like just imagine value everything in US dollars? Like for value in Brazil company, we just project out like the future cash flow in Brazilian, and then use the forward rate.
What do you think drives the forward rate? First, the forward rates are going to dry up after 2 years. You're not going to get 10-year forward rates.
Yeah.
Right.
So I mean, but it's like the
What drives the forward rates?
like the interest rate parity, like the,
Which is driven by
so,
inflation differences. Ultimately, everything boils down to inflation.
Yeah, so I mean-
So guess what? If you do things in dollars, you still have to estimate inflation.
yeah.
Because
So I
I-
mean that's the same thing. It's like the
But you end up with the same answer. Right? It's actually more work starting in the local currency and converting to dollars than it is to just do everything in the local. I mean, how much more work is it to bring the same? After all, if you're going to estimate inflation, it's no more work to adjust the risk-free rate than it is to adjust the cash flow. There's nothing gained.
yeah, that makes sense.
So it's about the same work. So you're not, if it was
But like
less work,
theoretically, it is correct.
it should be the same thing.
Thank you.
Yeah. 2 years. It's really messy, especially with the government bond to get the standard deviation. But stocks, I just use 2 years. In fact, on Bloomberg, you type in HVT for any index or any stock. It'll give you the historical volatility in that stock, which is the standard deviation.
I sent you an email about my Amazon valuation. I got like really, really different numbers because the operating margin
So for Apple, the sales to capital ratio cannot even be computed because the investment capital is negative. No, I didn't use the negative one for Apple. For Apple, I used the industry average. Because you can't use a negative one because then you'll actually have your investment capital disappear over time. But if you have a company with a historical sales to capital that you trust, you can use it. For Apple, that's not even a choice because once it turns negative, you can't even use it. Don't ever look up a margin. Compute it yourself. Operating margin is operating income divided by sales. So why would you want somebody else to tell you what the margin is when you know what the operating
They gave me the operating income, which was like only 13
billion, 13 billion.